Hey everybody, Courtney Smith here. I'm here to answer all your questions. It's going to be very exciting. So we do have already a bunch of questions ready to go. I'll share those with you in just a minute. But you can also add more questions in the chat box over there. So why don't you first of all start out by telling me where you are and just tell me what city you're in. That would be spectacular. I'd love to know. And of course, I am using brand new software, so who knows if it's going to work, all right? But we'll find out. All right, if you could put your city, that would be great. All right, while we're waiting for that, let me get going. I'm going to share my PowerPoint presentation, and once again, this is all new software for me. This is the first time I'm using a YouTube Live, so we'll have fun seeing if it works. So let's go over here. I'm going to share my screen. And here we go. And all right, let's get going. So the first question we've got here is from Angelo in Dubai. And by the way, I'm broadcasting from Dubai right now. Thank you very much for streaming these valuable shows. I have a question though. What do you think of brokers who do not allow to trade IPO companies, specifically eToro? Any reasons? So let's stop right there. Brokers are in the business of making money. And remember that I was a mutual fund manager for a long time, a hedge fund trader for a long time. And one of the things that was quite clear to me was they really only wanted to have big customers participate in the good IPOs. So it's not even a matter that they are not allowing you to do it. You're probably just too small. And why should they give you a special deal when they should be giving, big, huge companies, big, huge hedge funds and mutual funds? They need to be paying those people, and the way they pay them is to get them into the hot IPOs. The way I look at it is that if a broker were to offer me an IPO, it's got to be a piece of garbage that they couldn't sell to their big customers. You got it? All right. What's your thoughts about trading IPO companies? It's hard, okay? It's hard to do because we don't have a lot of data on them. We have to be very strict. It's like an auction. When you go to an auction, you can get all excited because the auctioneer is there trying to get you to do a bigger order, a higher price. So what happens here is the IPO people, the investment banker, the Goldman Sachs, the Morgan Stanley, the Merrill Lynch, they're trying to get the price up as high as they can. But we have to be disciplined. Just like when we go to an auction, we say, I'm going to pay $100. We have to stick that 100. And if it goes to 101, we have to get out. So you can definitely make money in IPO companies, but it requires more discipline. You have to analyze it from a fundamental perspective because, of course, there is no price behavior at all. So we can't use best of the best the way it's set up. What you need to do is look at just the fundamental side of it. You have to ignore the relative strength, obviously, but you need to look at the EPS as well as you can, okay? So the problem too with IPOs, particularly in these days, this is not the dot-com boom anymore, is they still want to bring the stock at 20 and have it pop to 25 right away. So they still want to do that. And that $5 is a profit they give to their best customers. And of course, the broker owns a huge position. So they're making that $5 as well. So I don't really do IPOs in my own personal trading for the simple reason that it's so much riskier unless you get the allocation of the hot IPOs. And guess what? No brokers offering me any of those. They did when I was a big hedge fund customer. When I was a big mutual fund customer, I would be offered IPOs. But now, as a retail investor, they don't offer me any money at all. Okay. I've been reading your book, How to Make a Living Trading Foreign Exchange. I find this book to be very interesting and informative. To be a successful, one must be able to determine whether a currency pair is trending bullish. Pool. So what I did was that I said, and so I like rules. I think that if you trade with rules, you'll make a lot more money, particularly if you're a new trader. You want to trade with rules. It makes everything so much easier. So what I did was I said, let's define the rules. What is a high? What is a low? So what I said is that there's lots and lots of highs and lows, okay? But I said that if a price makes a high and we only know it's a high the day after that's clearly very important. Sometimes you'll see a 3-bar high and it's totally unimportant, but I'd say it works about 90% of the time. And the big advantage is it's a rule. You have a rule. Everybody on the planet would come up with the same determination if it's a bull, bear, or neutral market. Now, that is a powerful thing. Just knowing the trend of a market will change your trading. I see one of the most common problems of new traders is they fight the market. They fight the market, and I'm going like, a debit spread is great. Both of them are combined, and we for beginner what your risk is. Most very so I like Sunday night. But it would be all stocks. The question is should you double the size? The answer is it's up to you. So you definitely, when it's double bullish, the market usually is exploding. So you definitely need to be putting on bigger positions. I would say at least 50%, maybe double, but definitely bigger. The answer to how much bigger is up to you and your risk tolerance. So I can't really answer the question directly. Doing covered calls as part of the option paycheck class. All right, so first of all, we sell a class called option paychecks, and all it is to end. So let me paycheck class. Please clarify when it is the time to decide the trade is not working. Do you hold it to get a bounce to get out? No, I never do hold to get to a bounce, because that's trading on hope. Okay, that's trading on hope. $50. Okay, so we're looking at two different things here: technical support and the potential loss in the trade. We never, when the market starts to go down in a covered call, that's okay. We can still actually make our full $10. It just can't go down too much. So if the market goes below strong technical support, you got to get out, because the stock's no longer in a bull market, and covered calls are a bull market strategy. So you've just got to get out of them, period. That's it. Now, the other thing that we're looking at is we don't want to have a losing trade, or if we have a losing trade, we want it to be very small. So if, let's say we have a $10 premium, that means that the price of the stock can go down to $90 and we'll break even. So we have protection on the downside. So I'm hoping that the strong technical support is 90 or above. So if we do get stopped out of the stock, it doesn't matter. We've made a little bit of money. Maybe we've broken even, but let's say we'll make a little bit of money. The hard part is, what if the strong technical support is at 85? Well, now the price goes down. I get stopped out of the stock at 85. I have a $10 potential profit in my option. The option probably at that point is worth less than $1. But what will happen is, typically I get stopped out of my stock on the downside, and I let my option stay alive, because 90% of the time it's going to expire worthless, and I'll pick up that extra $1. Now, the reason I don't use a bounce is because I don't know where that bounce is coming on, and I need to control the risk, and waiting for a bounce does not control the risk. You might be lucky and it might bounce and you get out at a better price, but then if it's back up above 100, why would you get out? So I never use a bounce. All right, I've never seen the complete rules of how to divide the funds for one's portfolio, as in what percent do you invest of available funds and when do you get out of a trade? Well, in my class, in my foundational class, Stock Success School, we all, or How to Crush the Futures and Forex Market, we teach risk management. We tell you exactly when to get out of a trade. Okay, so that's a done deal. That one's easy. We teach that all the time. What we do not teach is the first half of your question. And the reason that we don't is because it's not up to us. You see, let's say we're trading option paychecks. And let's say we're buying stocks because Wall Street winners recommended them. Let's say those are the two parts of our portfolio. How much you allocate to option paychecks and how much you allocate to Wall Street winners is 100% up to you. And I can't give you guidance on that. The answer to the question is, what is your risk tolerance? And what is the purpose of your trading? So, for example, I could say, I'm 69 years old and I got a pile of money and I don't really want to take a lot of risk. Well, guess what? I may put 90% of my money in option paychecks and only 10% in Wall Street winners stocks. Okay, what if I'm 25? I'd put just a little bit into option paychecks and I'd put nearly everything into Wall Street winners, because Wall Street winners is more speculative. It has risk, it's riskier, but the profit potential is much higher. Now, I used age as a criteria, but there's other criteria as well. Your personality. Some people are risk averse, some people are gamblers. That's going to change the percentage that you're going to use. Okay, so that's the way I look at it. It's really up to your risk tolerance as to how you divide your portfolio into the various strategies and instruments. Okay, what are the indexes, funds, and stocks specifically you use to trade Bitcoin? I use the futures contract, and I use CFDs, contract for differentials. Futures contracts are rather large. You need a lot of money to trade them, whereas CFDs, you can have a few $100 and you can trade Bitcoin. So, CFDs give the greatest flexibility. The bid-ask spread is wider than the futures. The futures, you need a lot of money. I don't use any stocks or funds or indexes at this point because I can trade and get 100% correlation using CFDs or futures, and I don't have to come up with a bunch of money. Okay. Can you please explain the SIPC and FDIC protection for trading accounts, including IRA and Roth trading accounts? There is no FDIC protection for trading accounts, okay? But let me just describe what these are. FDIC is Federal Deposit Insurance Company, and that insures bank accounts. SIPC is I forget what it stands for, Stock Investment Protection Corporation or something. I don't know. Anyway, that protects stock brokerage accounts. So FDIC never covers stock brokerage accounts, and SIPC never covers bank accounts. That's the difference. In 2008, they raised the FDIC protection for bank accounts to $250,000. And what that means is if you deposit up to $250,000 to a bank and the bank goes bankrupt, the federal government will pay you the $250,000. So if you have $1 million account and the bank goes bankrupt, you'll get back $250,000 and you'll lose $750,000. SIPC is $1 million protection. So you can lose up to $1 million when a stockbroker goes bankrupt and you'll get paid back that money. But anything over $1 million, you don't get the money. Sushil here from India. I wish India was open. I'd go back there. When should we sell call on our long-term investments? Here I want to know about sell call on a fundamental basis and not on a technical basis. In a way, I don't feel I can answer the question, Sushil, because I don't have enough information from your question. First of all, what is a long-term investment? Is that over a year? Is that over 6 months? Is that over 5 years? Whatever. But if I understand it correctly, you're going to buy a stock and you're going to hold it for a long time. So when should you sell a call against that position and turn it into a covered call? And the answer is whenever the call is overvalued, quite frankly. That's the main thing you should do. You need to determine you want to sell overvalued calls. You never want to sell an undervalued call. And what's the point of selling a correct call? Now, I can't go into determining whether it's over, under, or fairly valued. We have a bunch of courses to do that, and it would take me too long to explain here. So, but I would also recommend that you do think about technicals on the underlying stock. Okay. Also, let me know how I can learn it from you. Well, like I say, if you go to optionsuniversity.com, we have probably 5 courses that'll tell you how to do that. A lot of them are taught by some great teachers that are not me. One of the courses is called the Option Success School, and that's the one where I teach, and I specifically teach this technique, covered calls. You can also go to OSS2021.com and buy the course there, or optionsuniversity.com, and there's many choices there. Number 7, you shared that people thought it will be the end of inflation as the Fed talked about raising interest rates twice in 2023. Why does the end of inflation cause people to buy long-term bonds and result in an increase in the bond price? Can you explain and share your thoughts on the bond bubble? Yes. So whenever we buy a bond or a note, let's say we're going to buy a 10-year Treasury note. First of all, I want to make some money from owning that note. So the interest rate is composed of several sections. The first one is I need to make a profit. That's called the real yield. That's one of the three major components of what's in a bond interest rate. The next one is credit risk. I have credit risk. Maybe they'll default on it. So I need to be compensated for press inflation because the economy will sag, which will create competition to companies will compete more to get more customers, and raw material prices will drop and labor rates can't go up. They may even drop, unusual, but possible. And so if inflation goes down, then let's take a look. Let's say I want to make 1% real yield. Let's say it's a treasury note, so there's no credit risk. And then let's say I think inflation is going to be 2% for the next 10 years. Then I need an interest rate of 3%, 1% real and 2% inflation premium. So I need 3% to break even. So if the inflation, if I think, gosh, I don't think inflation is going to be 3%. I think it's only going to be 1%. Then I only need 2%. Well, if bonds were yielding 3% and they now go to 2%, then that causes bond prices to go up. Because when bond prices go up, interest rates go down and vice versa. So the thought that the Fed's going to start raising interest rates in 2 years gave the market the idea, well, I guess we don't really have to worry about inflation over 10 years. Maybe just it is transitory. Maybe generous Jerome Powell is right. And the inflation at 5.2%, it's only going to be there for a few months and then it's going to go back down really low. And therefore, I don't have to worry about inflation. My demand for what I want on my interest rate for my bond is only 2%. I don't need 3% because I don't think inflation's going to go up to 2%. So that's what they're thinking about, okay? The bond bubble we're in, or maybe we're just past, but we're basically in the middle of the largest bond bubble in American history and one of the greatest bond bubbles in all of human history. All bubbles get popped. All bubbles turn into bear markets. That's a done deal. Now, the problem is when. Japanese bonds got down to basically 0% back in 1990. So, of course, I and many professional investors, we shorted the bonds because we said this is unsustainable. 30 years later, still at zero. That trade, shorting the bond bubble in Japan, became known as the Widowmaker. Those like Ethereum, which are better technologically. Okay. For sure, it's going to have more and more. I mean, really? Listen to reason. The been the treasurer of a bank and so on and so forth. I CAD, there's not one exchange rate. There's two, the bid and the ask. So if you buy at the ask, you sell at the bid. They're always slightly different. So you say, can you give me an insight how to best keep my profits? Is there a rate of exchange that makes it not worth trading? No, there's always a rate of exchange. The question is this. If you're in Surrey and you open up, let's say, a brokerage account, and it's denominated in US dollars, which most are globally, if If you just let the money sit there and the US dollar goes up, of course you make money. So your problem is if the US dollar goes down, you could start to lose money no matter what your investment is. So when I moved to Canada, the exchange rate was 103. The Canadian dollar was 3 cents more than the US dollar. Now it's like, I think they give them away, don't they? I think they're given away at the border. But anyway, I could be wrong on that. So so what you need to do is you need to lock in and the way to do it. But basically what you do is you're long US dollars, and now if you open an account in US dollars, you're long US dollars, short Canadian dollars. So what you need to do is you need to in a foreign exchange transaction buy Canadian, sell dollars. Now you're back to Canada and you don't care what the exchange rate does. You've hedged it out of your equation so that it's no longer a consideration at all. Send an email to support@wealthbuilderllc.com. In the subject, say for Courtney, and I'll answer your question. Okay. Another question. The timing and then your first pyramid would be 400. Your next pyramid would be 300, then 200, then 100. That's why they call it a pyramid, because the original idea of pyramids was the number of units would be a lot at the bottom and few at the top, because of course we're getting closer to the end of the market. And that's a very conservative way to pyramid. I look at it as a cone. So I buy a 1% risk at the bottom. I buy a 1% risk on the second unit, the third unit, et cetera, et cetera. I just keep on going. Now, I know that the last trade and maybe the last two trades are going to be losers. I know the last trade, 90% of the time it's going to be a loser. But the question is, I don't know if it's the first pyramid or the 10th pyramid. So I just keep going. So my strategy is more aggressive than the classic pyramid, but it also makes a lot more money. Okay, if you miss the best timing, etc., the breakout or the ascending triangle, when will you build a long position? On the next signal. So if you're using channel breakout, I get a channel breakout signal, trend analysis, 6-day swing, any of the techniques that I do, classic charting, you talk about ascending triangles, you're looking for the next signal on any technique, because if you get a signal, it means you have a place to put your stop loss, and therefore you're in control of your risk. Are the above strategies different in stocks, indices, or other markets? Look, I use channel breakout in CFDs, futures, and stocks. But when the instrument It's 1990, but it'll be bad. It'll be 50%. The problem that I have with Taiwan is, what if they tighten monetary policy and China gets closer and closer to taking over Taiwan? So there's a geopolitical risk also because of China being next door. So that will exaggerate any moves as well. So right now we have to maintain a bullish stance, but we have to be nervous about our situation. We have to keep our stop losses tight. We can't space out. We can't use hope. We have to be very strict at our risk management in Taiwan. Okay, that's the end of those. Are great questions, by the way. Now what I need to do is I need to stop sharing. Okay, now I think, there you go. I think you can only see my face. Now, do you have any questions? Let's see here. Okay. 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 It looks like I don't have any questions, comments. Hang on. I'm just trying to learn this platform here. Okay. It looks like I don't have any more questions from you. We just went over the ones that were broadcast, that were sent to me early. So I want to just say I really, really appreciate that. That is fantastic. And let's carry on. So I'm going to go over these same questions in about 4 hours. I'm sorry, about 7 hours, because we're trying to cover the whole globe. So we have to do it twice a day. So if you have any questions and you want to come to it, I'm doing this at 1 p.m. Dubai time. I'll be doing it again at 8 p.m. Dubai time. So if you have any questions that you think of over time, come to that one. I'm going to go through the same questions that I did here, because I don't know where those people were and whether they're watching our first presentation or our second presentation. But since there's no more questions from you guys, because I did an incredible job explaining everything, so you didn't need to ask any questions, of course, we will leave it there. And I want to thank you for coming. We'll talk to you later.